Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. And today, we're going to be talking about planning and placing what I would call a quick strike bearish trade, even while the markets are still hot. Yeah, the S&P 500 right up there against all-time highs, but we're going to be seeing if we can spot narrow bearish trading windows, and we're going to plan and place a bearish vertical spread trade within those windows. If they play out, we'll see how it goes. But I'm really looking forward to this discussion. Before we can get to that, though, let me first of all say hello to everybody who's already chatting in out there on YouTube. Seeing a lot of familiar names, some that are brand new, so welcome. But hello there, Frank, and Life in the Fast Lane, Will, Richard, Josh, Kay McKee, Jack, Paul, Kevin, JDLMI, Sharon, everybody else. Great to have you here. For you returning veterans, we definitely appreciate your ongoing attendance, your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream if you'd like to be in our audience. We'd love to have you here. So this is a Thursday webcast series. We kick things off promptly at 11 Eastern time if you'd like to join us. Now, I also want to let you know that my very good friend Brent Moores is going to be hanging out in the chats with us. He's going to be keeping an eye on those chats, watching out for any questions. If I can't get to those questions, Brent's there to pick up my slack. Thanks for having my back there, Brent. Brent and I have been now working together for more than 2 decades at this effort. So Brent brings a ton of experience and knowledge to this discussion. Now, Brent and I would also like to issue an invitation to everybody listening to follow us on social media. You can find Brent and me on X. You can find Brent there. His handle is @BrentMooreCS. Mine is @CameronMayCS. Now, you can also follow me on LinkedIn. LinkedIn, my profile can be found by going to linkedin.com/in, and then you throw on the /CameronMayCS, and that'll take you there. You can give me a follow there. But let's get into this discussion of planning these quick strike bearish trades, even while the markets are still hot, looking for those narrow bearish trading windows. But as we do, of course, there are risks involved. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. And investing involves risks, including a loss of principal. All right, so let's set an agenda for today's discussion. This webcast is part of an ongoing series of webcasts. So we have already in place some example trades. We're going to take a look at those example trades, see if there's some action that needs to be taken on those. And I think there is for at least a couple of those. Then we're going to take a look at what's going on with the markets right now and use that to set sort of a framework for a discussion of planning these short-term, very quick strike bearish trades, even while the markets are bullish. And that's going to involve planning and placing an example bearish vertical spread trade today. So that's what we're going to be doing. Let's go right to the Thinkorswim desktop trading software platform. Here are our current 5 positions. First of all, starting with Amazon, which was doing poorly this morning, doing even worse while I was waiting and watching. High anxiety. Wish I could have addressed this an hour ago. But in any case, no, I'm kidding. It's a paper money trade. No anxiety attached to this. But I did want to talk to you about it. With this, we own a long call. What is going on with this position? Here's what's happening with Amazon. We took a position back here, bought some long calls, sold short calls against that position. Those short calls have now expired worthless, but the long calls really broke down through a support level. We've seen a rally, and as of this morning, when I was looking at this first thing this morning, we're right up against that resistance. Maybe from a technical perspective, not looking like the strongest scenario to be in something like a long call, so I was considering exiting, but I had to wait to turn the camera on before we could do that. So we continue to sell off here. The decision here was, well, does the trader continue this as the diagonal spread it was intended to be, which is a bullish position, or if things are starting to turn, is it time to just take our lumps and get out? I think that's exactly what we're going to be doing here. This trade still has 43 days on those long calls, but I'm just going to close those out. So those were purchased for 16, just to put this into perspective, purchased for $16, worth a fraction of that at this point. That's what can happen if we break down. You might wonder, why didn't we get out of this earlier? Well, we didn't have this webcast last week. We had Thanksgiving instead. And I don't place trades in this portfolio when the camera's not on. Greg says, rip off that Band-Aid. Exactly right. So let's rip it off. Let's right click. We're going to create a closing order and sell these 2 calls. Now that we've finally, after 2 weeks, had a chance to get back together to talk about it, I'm just going to put these in, believe it or not, as a market order. Obviously, there's certainly a risk when placing, and actually, let me frame that risk. Here's our position right here, 43 days. If we look at that, there it is. You can see that green flag indicates where that position is. Amazon, highly liquid in the grand scheme of options trade. So there's not much of a spread between the bid price and the ask price, but the wider that spread is, the bigger the risk associated with submitting a market order, because we're just saying, hey, we'll take whatever the market will give us just to get out of this thing. We might not be thrilled with that, but wide spreads can lead to even less favorable exits or even fills if we're using them as a market order on an entry. But let's go back down here to our order, and I'm going to switch this to a market order just to close this thing out so that we can get on with our discussion. Let's see what we fill this for. Let me click confirm and send. We're putting in an order to sell those 16th of January, 240 calls at the market price. Max profit, max loss don't matter. This is a closing trade at this point. There is a commission, though, to be paid on our 2 contracts times 65 cents, $1.30. Let's send that order off, and we should get a quick fill here. And I wanted to emphasize getting that thing filled because there's going to be a lesson there. Pardon me. There's going to be a lesson there in just a moment for a previous trade that's actually now still a current position. Anyway, let's move on to our Broadcom trade. This one's treating us significantly better. This is a long call vertical spread. Bought the 330 calls, sold the 335 calls. Those hit their expiration tomorrow. With this trade, we prefer to be above 335 as we get toward that, as we get to the 5th of December. It's the 4th of December right now. And the stock is up there at 380. Not only is it above 335, it's considerably above 335. So let's look at that one. There's our vertical spread down here. Here's our green zone. This is our maximum theoretical gain zone. We want to be above 335, and we are solidly above 335 right now. So we could just let this go to expiration. Most likely outcome there is that we're assigned on the short calls. We exercise the long calls, buy for 330, sell for 335. That's a $5 realized value. We just subtract how much we paid for this trade to set it up to calculate the reward or the gain at that point of profit. But there is a tiny outside chance if we just decide, oh, it definitely, this is done. This is a done deal, and we leave it. There's a tiny chance, it's not terribly likely, but it's still within the realm of possibility, that some news comes out on Broadcom and spikes these share values back down on through our vertical, and we could still lose all of it. It's almost certainly not going to happen, but it could. That's a risk a trader's taking anytime they start to get confident and think that the deal is done. Before the deal is done, I'd just like to call that out as a possibility. So instead, what we're going to do here, we have 5 contracts. Let's just close these out. What we're looking for is for the distance between the 2 values to be about $5. And you'll see right now, that's almost where it is. 49.60-ish minus 44.80-ish means that we're at about $4.80. We're right about there for what we might be able to close this out for at this moment. So here's the decision the trader might want to make. Do we leave this on and let it push toward expiration? And maybe realize an additional, and not just maybe, almost certainly, I have to qualify it with almost because it's not guaranteed, but almost certainly we make another 20 cents per share on 500 shares. That's another $100 that could be made on this trade with a very, very high probability of that's exactly what happens. Now, the other part of that equation, though, is if this stock collapses, we could lose the full value here. That's about $2,400 of value at this point. So $2,400 of risk, but with a very low probability of realization of that risk versus $100 of reward with a very high probability of that reward. I actually came into this thinking, I'm going to close this out, but I'm not going to. There's that tiny off chance that we get that collapse in Broadcom's value between now and tomorrow's close. I'm going to let this go. See if that happens. Then we can talk about it. Oh, look at that right now. It's at $5. If we could get filled at $5, Greg says we could close 4 of the 5. That's another thing we could do and still have the same discussion. Right, Greg? All right, let's do that. Right click, create the closing order, sell out of these vertical spreads, but I'm going to do this for 4 of the 5. There we go. Leave that 1 on for a future discussion. $5 credit, we might be able to get that. Let's back off on that and say that we're willing to get out, even if we can only get $4.90. Let's click confirm and send here. And by the way, look at the spread here. When contracts go this deeply in the money, that spread between the bid price and the ask price tends to widen fairly dramatically. So I'm not terribly confident in a fill at that $4.90 value. We'll see. Well, if it doesn't fill by the end of the day, then what happens? Well, it just doesn't fill. We still have our 5 contracts on both sides. And most likely we just hit expiration, assigned at, or we exercise at 3:30, we're assigned at 3:35, maximum gain. That's most likely. All right, but let's click confirm and send. Max profit, max loss. Again, this is calculated as though this is an opening position. It's not, it's a closing position. There is a commission to be paid by 4 contracts on both sides. That's 8 times 65 is 520. So let's click send. Actually, also note, please note, you've selected a weekly option series. Yeah, this is a weekly option trade. It's not a third Friday expiration is what this is emphasizing, with a non-standard expiration date. Yep, we knew that when we got in, and we know it now that we're getting out. And let's click send. And, well, that was quick. Closed out at 490. Okay, good. Nice profit on that trade. There's you can see there's the remaining unrealized gain on the remaining contracts, and it just shrunk. Oops, it's waffling around quite a bit. That's because of the spread between the bid price and the ask price kind of moving around. Next up, we have NVIDIA, another long call vertical spread. This is a more recent trade. Still some days left on these contracts. 170, 175. We'd like to be above 175. The stock's at 181. So here's what NVIDIA is doing, and we're not going to be making any changes to this one at the moment. So we just recently took this position here, thinking that we had a potential support level right there at about that 180 mark. Well, we broke that support and came down and actually teased breaking through that vertical spread, but recovered. And we're back up above that support again. We're going to keep an eye on this, but seeing that we're at 181, it sounded like we're a great distance above our vertical spread. Well, we have about that much wiggle room down to the 175. I'm going to let this one continue to work. There we go. Now for our Tesla trade. Another long call vertical spread. Bought the 400s, sold the 410s. We'd like to be above 410 as we move toward the 19th of December. And we're at 448. So Tesla's doing well. Here's what that looks like. There's our long at 400. We have 6 contracts at that level. There's our short at 410. We'd like to be above that in our green zone. If you're wondering where these green boxes and red boxes and colorful lines came from, I just drew them on there. I'll see if I get a chance to draw them on for today's trade as well. But this one looks good. It's well above our strikes. We're moving toward that expiration. We're going to hold that let it see if it can continue to improve. It looks like the difference between those two strikes is in the neighborhood of about $4.50. All right. Yeah, definitely have not realized, but reached most of our potential gain. I'm going to let that one work, though, give us more to talk about in future webcasts. But then we have this. This one kind of threw a kink in the works to me this morning. We decided last time we met, back on the 20th, we're done with this trade. We actually saw a breakdown under a support that we were planning. If we fall below that support, we're done. Well, that's right. See, that's the Cameron color spread. Yeah, I just color it. I just draw those things on there. Anyway, here's what's been happening with UNH. This is right now we own a long call. This has previously been part of called diagonal spreads, but the short contracts have expired. So here is that history. So here's UNH. We noted an inverted head and shoulders pattern with an island gap reversal down here at the bottom. Both of those basically an indication that maybe prices are starting to climb again. And we saw that break through the neckline of that inverted head and shoulders. And that seemed to be acting as a new price floor. So we took our new bullish trade, bought some calls, sold some short calls against that long, and created a diagonal spread. Now, we sold some 360 short calls. Those we've closed for a 320 profit. Subsequently sold some 380 short calls. Those expired for a 250 profit, leaving us with our long. The last time we met was on the 20th. That was right here. Our stock had actually broken back down below that neckline or that support level. And we had a note here, consider closing if support breaks. And we decided we were going to close. So we put in an exit order right there. So back on the 20th of November, we put in this exit order. And I went on with the discussion. And guess what? That order never filled. It just expired. So that allowed our short contract, instead of exiting it, it just expired worthless. But our long, we still own. So what do we do with that long now? Well, situation seems to have maybe changed since then. We appear to be back up above this support. Ooh, and we are darn close. We're right at that support. So I think what we're going to do is just reinstate the previous logic of this trade. It was a mistake, just an oversight on my part, but that's where we find ourselves. The order didn't fill. I didn't follow up on it. And so that leaves us with this long. I think what we'll do is maybe sell a new short position. We own the long. It's behaving more bullishly. As a matter of fact, there's kind of a mini inverted head and shoulders right here. Maybe signaling that if we can hold this support, possibly moving up, maybe up to previous areas of resistance. Sia says it's toying with support, let it run. Yeah. So let's go ahead and add to this, re-diagonalize it. We own the long, let's sell another short call against that. Before I do that, though, I want to say this. There's a survey in the chat window right now for the live attendees. So if you turn your attention to that chat and click on that survey link, let me tell you something about our surveys. First of all, they're very valuable. So if you take the time to fill those out, it's always helpful. Also, they're really short. 2 multiple choice questions, a comments box, and a suggestion box. In any case, if you take the time to fill out those surveys, that information is sent right to me, and that gives me the chance to read through that data. I read your comments, and it's always helpful. So I know that I filled out surveys before, and I've always wondered, where does this go? It just drops off into the abyss for whatever restaurant I'm giving a survey for, or whatever corporation. Nope, that stuff goes right to me, so it's always helpful. All right, thank you for doing that. But going back here, yeah, Kevin says a small inverted head and shoulders on UNH. Now exactly what I noticed there, Kevin. Yep, possible short-term inverted head and shoulders. And that looks like that has a depth of maybe, where's the low on that inverted head and shoulders? Maybe I'll call it 308. The neckline's up there about 341. I'll do a little bit of rounding. Let's call it $30, $35. If we come $35 off that neckline, that puts up around 375. that's going to be right up against this previous resistance. So whether we did that sort of pattern analysis, not everybody does that, or if we're just looking at where's the next area of resistance, that might be up here around 375 or 380. I wonder, could we sell? Let's go have a look at the trade tab. And what might a trader get for selling? Let me look at these shorter term contracts first. Is a 375 going to give us much credit there? Not much. Let's move out a little bit further. Let's go to the 16th of January. I tend to stick in these demonstrations, I'll stick to the third Friday expirations, the traditional monthly expirations. They tend to have greater liquidity. Nothing inherently wrong with the weeklies. As a matter of fact, we're going to be trading those in a few minutes. This is a spoiler alert. But let's look at the there's not a 375 for the 16th of January for UNH. We can choose between a 370 and a 380. How about we do this? Let's sell that 380. That looks like that's trading between 365 and 385. That'll be up here. Let's draw a line up here. So this is where those mysterious lines come from. And let's carry that out here a little bit further to get a little bit stronger credit, but it's going to leave us with a cap for a longer period. Let's sell that one. Sell the 380. Let's go to the bid price and click on that. And we just have one long contract. So let's just do one short contract, selling the 380. And let's try to get the 365 credit for that. Let's set that as our limit. Anytime we submit a limit order, there's a risk the order might not fill, of course. But there is a commission to be paid. So let's see if we can quickly get that filled. And there we go. We actually sold that for 385. We were willing to accept as little as 365. It filled for 385. So we now have a diagonal spread again. We own the 300 long call, which expires in 743 days. And we've sold the 380 short call, which expires in 43 days. All right. There we go. So that's it for our current positions. Now let's plan to place a new trade, but this one's going to kind of go against the grain, I think, for a lot of investors and traders out there right now, because we're going to try to squeeze in a quick bearish trade in today's markets. And this is at a time where the S&P 500 is trading, about 1% off all-time highs. And it's had a terrific bullish run. I think, anytime I apply words that are kind of, there's sort of a judgment call to call something terrific. I don't know. For the bulls, this has been a strong run since April, whatever label you want to apply to that. So why would we do a bearish trade? Well, even in strong bullish market conditions, there might be times when a trader sees that most stocks have already run up quite some distance. And those might be times where they might pull back. There may be some profit taking. There's no guarantee that they're going to, but yes, there might be little narrow windows of time when a trader who is otherwise bullish might see maybe it's time to layer on some bearishness, maybe to add some balance to potentially a portfolio that's quite bullish already. And that's exactly where we find ourselves. We just have exclusively bullish net positions in place right now. So let's add a bearish trade. And this might be done shortly, well, just as the stock market has run up to an apparent price ceiling. So that would be a common approach to the timing of this sort of a position. And as a matter of fact, it's one that we've done previously. Let me go back to our archives. And I'm going to emphasize this. If you haven't subscribed to our Trader Talks channel on YouTube yet, do that right now. You can just pop down below the video, click on the subscribe button, because this is where you can join our live streams, but you can also find our playlists of previous webcasts. So I'm going to go to the playlist for this webcast series. Scroll on down. It's right toward the bottom. It's right there, long verticals and diagonals. And if I go to view full playlist, about 2.5 months ago, we also did one of these quick strike bearish trades. It was right. Let's see if we can quickly find this. Trading short-term bearish moves in a bull market. So that trade, let's see, what was that? That was trying to remember which stock that was. In any case, you can look through the archive. It was a quick, I think it was just it turned out to be an overnight trade. We didn't intend it that way, but that's the way it worked out because we hit our profit target so quickly. So we're going to be doing that again today on the technical evidence of a recent run up in the S&P 500 and the apparent area of resistance just above. Neither of those facts guarantee that stocks are heading down, but we're going to see if that opens up a narrow window of opportunity for a bearish trade to be added to maybe an overweight bullish portfolio. So Eric says, is there a bull-bear ratio that is typical for a portfolio? Not necessarily, Eric. It really comes down to the outlook of the individual investor. There are lots of traders out there who just are bullish at all times, and what they'll do is they just adjust the degree of bullishness. Maybe they just go more to cash. There are other traders who feel perfectly comfortable getting into bearish positions. So it really comes down to how the trader prefers to handle that. And some just don't make any adjustments. They're just long-term investors, and it's just buy and hold. And there's been a long-term attestation of the effectiveness of that strategy over the long run for most portfolios. Yep, buy and hold has pretty good history, pretty good track record. Anyway, let's go have a look at a stock. And guess what? It's going to be a familiar stock. I'm going to go right back to Amazon. We were just in a bullish trade, just didn't work out for us. And we've wiped the slate clean there, meaning we've exited, took a loss. I'm going to right click on these drawings and just clear that drawing set and look at this through a fresh set of eyes, but with an emphasis on this fact. Let's draw this back in here. Yeah, right around here, we've had some resistance, 235 up to maybe 240. Let's come down to about here, maybe about 235. That's been a pretty good, it was a price ceiling through really the bulk of the last 12 months. With that one, what it looked like it was going to be a strong bullish breakthrough, and it just didn't work out. Seems like the bears have some pretty solid control. We'll see if that persists. But we're going to be placing just a quick bearish trade. Let's say that our trader has the outlook now that we bumped our head against that ceiling again. There's a big, this is what might be called a shooting star candle. And let's just say they think maybe we're heading back down here to possibly this area of support. Lots of things that a trader might do to take advantage of what they see as short-term downside bearish opportunity. They might leverage into, let's say, a long call or something like that. In this webcast series, a long put, I should say, in this webcast series, we just do long diagonals and vertical spreads. I get questions all the time. Hey, why don't you do, some other strategy, simpler or more exotic? Because this webcast series is called Long Verticals and Diagonals, so that's what we stick with. So for this one, we're going to do a bearish vertical spread, but with the intention to just do it quickly. Try to hit a quick target and hit the trail. It's entirely possible we might be taking a quick loss and hitting the trail. But here's the trade that we're going to place. We're going to go to the trade tab. We are not going to be trading 43 days out. Instead, we're going to be moving up into weeklies territory. There are actually contracts that expire just tomorrow, and the trader might set up a trade with that. I'm going to go out just a little bit further. Let's do an 8-day trade. So this thing's going to be done, for better or for worse, in 8 days. Let's just say that looking at that chart of the S&P 500, our trader thinks that there's a little bearish window there. Might be a week, might be 2 weeks. Jeff says, can you show us how to do an OCO with the vertical? Yeah, let's do that, Jeff. I think that's a good idea. So what Jeff is implying, is asking here is, let's enter this trade and let's have an order to take our profits. Let's also have an order to take our losses, whichever one of those happens in the next 8 days. So let's go back to our chart of Amazon. and make a decision here regarding the placement of our strikes. And with resistance up there around 235, I wonder if we could get an order in. I wonder if there's going to be any meat on the bone, basically, for a trade that benefits as long as we stay below 235 for the next 8 days. Let's get the date for that. That's the 12th of December. Okay, 12th of December is right here. That's just to give us a visual reference point of the time frame that we're trading. So if we can just stay below 235 by the 12th of December, let's see if there's any potential money to be made with that. So I'm going to open up the 12th of December contracts. I'm going to go down here through these strikes. There's 235. So if we were to, let's say, buy the put above 235 and sell the 235, that would create a bear put spread. Now, what we need to determine is there any money in doing that? Any potential for profit? Here's a quick way to do that. I'm going to come up here where it says spread single and change that to vertical. And what that does is just pairs up each of the strikes so that we can then look at the ones that we were contemplating. And it looks like the bid price is about 175. The ask price is about 225 for that vertical spread. So if we were able to get, and there's no guarantee that we can, but let's say we were able to fill at the midpoint. That would be about $2. It would be the cost of that trade. On a $2.50 spread, how much does that leave for potential profit? If we can fill for $2, then there would be 50 cents left of profit potential. About 25% is the potential for reward there. Well, okay, that's if we go all the way up to 235. What if we fudged it down a little bit and we came down to, let's say, 232.5? That would still be above maybe this resistance area. I wonder, let's set up, here's the trade I'm going to do. I'm actually going to do it a little bit below that previous resistance. Okay? I think what we're going to do is let's buy the 235 and sell the 232.5 right there. So what that's going to require for us to be in maximum gain scenario is to be below 232.5 as we get to that expiration. So this creates sort of our maximum theoretical gain area. JDLMI says, why such a close expiration date? Because what we're trying to take advantage of here is what is let's say that our trader here sees the markets have been quite bullish, but they might be bearish for just maybe a week or two as they pull back down from highs. Here's a quick reminder. There we go. So here we are in this very bullish market environment, but bumping our heads against resistance. Maybe our trader thinks that we're going to pull down for just a few days, maybe a week, before we resume an upward move. So we're trying to grab that little window. That's it. So we're trying to be in and out of a bearish trade very quickly. That's the logic of our trade scenario here. So we don't want to be on S&P. Let's bring Amazon back up here. And let's go to the 232.5, 235 bear put spread. Looks like that might cost us somewhere between $1.65 and $1.90 to set that trade up. Let's say it's $1.80. If we spend $1.80 to set this trade up, that leaves about 70 cents of reward potential. Oh, Beauty at its Best says you appreciate my drawings, give you a newer perspective on how to view your charts. Good. All right. I'm glad that's helpful. Yeah. So let's make a plan. Here's going to be the plan for this trade, just the example plan. Okay. So we're going to buy for around, and we don't know, we're going to see how much this costs us, but we're going to call buy for around $1.80. If we spend that money is at risk. Best case outcome, theoretically, is it goes up to $2.50 in value. On a $2.50 spread, that's the maximum theoretical ultimate value of that spread. So let's see if we can get a portion of that. So 70 cents maximum gain. Let's say that our trader would be happy to take profits at, let's say, 2.30. So not all the way to $2.50, but if we can get out at any time in the next 8 days, let's say that our trader is willing to accept a 50-cent reward. How much would that be? Let's see, a 50-cent gain on a $1.80 investment is about 27 or 28% return that we're shooting to gain in the next 8 days. Ooh, but guess what? There's definitely risk here. And we might have to take a larger risk than the potential for reward because the probabilities are in our favor right now. So let's say that we take losses if we spend $1.80 and if instead of going up in value, we start to go down in value. Let's take our loss, our example loss here for, let's say, 90 cents, half of the value that we've invested. Yes, that creates a 90-cent theoretical risk against a 50-cent theoretical reward potential. Why would a trader ever accept more risk than reward potential? Because probabilities are in the favor of this trade. This trade is set up. We just need to be below 230, 232 and a half as we get toward expiration, and we're already there. And as a matter of fact, it's still cooperating. We're still kind of falling as we speak. So that's going to be our trade. But to go back to, was it Jeff that asked about putting in the OCO trade? I think so. Anyway, let's do that. So we're going to take our trade, 180, exit at 230. We're going to automate that by putting in an order to get out at 230. But we're also going to put in a second sell order, exit order, to get out if we happen to fall to 290. So here's how that might be done. Let's go to our vertical spread. In a couple of different ways. How do I want to demonstrate this? Let's do it this way. Let's do it this way. I'm going to go to the ask price for the strikes that we're considering. I'm going to click on that ask price, and that creates an order to buy into 10 vertical spreads. Now, right now, that's about $1.80. Let's see if we can get filled for $1. Oh, I might even have to fudge this upward a little bit to try to improve the likelihood of a fill while we're talking. But I'm going to still leave the reward and the risk the same. I'll just adjust that a little bit. But how do we put in those closing orders? Well, this is right now just a single order, an order to get in. Well, let's do 3 orders. 1 to get in, the other 2 to take profits or take losses. So we're going to change this to this first order triggers an OCO order. All right? If it fills, it's going to trigger what's known as a one cancels other order. So this goes to Jeff's question. I think it was Jeff. I like to give credit where credit is due. Before we put that in, let's just make sure, does this fall within our preferred risk parameters for the portfolio? We try to keep the risk under $4,000. If we invest, let's say $1.85, that'd be $185 on one vertical spread, $1,850 if we lost the full value on 10 vertical spreads. Yep, that's within our $4,000 risk tolerance. We could even dial up the number of contracts if we wanted to. I'm not going to. I'll just leave it at the 10. But here's how to put in those 2 other orders. There are different ways I could have done this. I'm doing it sort of a more manual way. So I'm going to right click on this original order now that I've changed this to a first triggers OCO and create an opposite order for my profit taking. And I'm going to right click and create an opposite order for my loss taking. All right. So let's customize these. So the first one, I'm going to leave that as a limit order. And if we're in for $1.85, maybe cost us a little bit more than we were originally planning, let's still shoot for a 50-cent profit. Let's put in 235 as our limit exit order. That's to take profits. To take losses, we're still going to limit it to 90 cents. So 185 minus 90 cents is we're going to put our stop in at 95 cents. Make that a stop. Good till canceled. There we go. Now, yeah, Sia is saying, didn't I say 230? I did, but I also thought I was only going to pay $1.80 or $1.80 to get into this. Then prices moved. So if I have to pay more, actually prices have moved again. I could move it back down to 180. Let's do it. We have time. Let's just change this back to the 180 that we originally planned. Let's just use all the numbers we originally planned to use because I think the markets are going to be cooperative and allow this. There we go. But in any case, that's how we place an entry order and also how the trader might take quick profits if available and how they might try to stop those losses if they start to emerge. Now, a stop is never a guarantee. It's not a guarantee that we'll sell at an exact price. That's just our trigger price. We might actually sell lower than this. But let's click confirm and send. And we're going to buy 10 of these verticals for a limit of $1.80 if we can. If that fills, 2 other orders are triggered. One to take profits if we can get up to 230. The other one to take losses if we fall down to 90. And then we're going to pay commissions getting in and getting out if that happens. And there's a note here. Please note that you've selected a weekly option series, yes, very deliberately, with a non-standard expiration date. So Ted Barron says, why do 10 contracts instead of one with a wider spread with the same total 1850 risk? There would be more room until max loss. That's another way to approach this, Ted. Yep. I'm going to click this and send this off. And maybe what we'll do in a future webcast, Ted, is weigh the pros and cons of that kind of an approach. Yeah. All right, but we sent that off. Now let's go see what's going on with our working order. All right, we're offering to pay $1.80 debit. The market price was $1.83. Okay, we filled at $1.80. So all the numbers that we outlined are just exactly what happened, at least to this point. So from here, here's what this trader is hoping for. We're hoping that the S&P is cooperative and heads down a little while. If it does, maybe Amazon doesn't have to move independently of the S&P. Maybe Amazon just moves down sympathetically with the S&P 500, and we can get to our maximum gain, or to our target. If, on the other hand, Amazon starts going up or the S&P starts going up and drags Amazon along with it, we have a stop in place, hopefully to minimize that bleeding. But guys, that's it. We'll see how this goes. We'll follow up on this next week, but this is what we do in this webcast series. We talk about trading long verticals and diagonals, and even sometimes we take kind of non-traditional approaches and do things like trading bearishly in what seems to be still a very bullish market. Hopefully this was an interesting discussion. I definitely appreciate your contributions to these discussions and your attendance each week. Thanks for joining us. I'm going to let you go enjoy the rest of our webcast for the rest of the day. Lots of stuff still in store for you. But before I do, a few quick reminders. First of all, let's talk about the full slate of educational offerings from Schwab, starting with the YouTube channel. If this is your first time here, if you haven't subscribed to our Trader Talks channel on YouTube, do that. It's a great resource. This is where you can join our live streams. You can also find our playlists of previous webcasts, like the one that we reviewed today. Now, another thing that I would suggest you do is that you follow your favorite Schwab presenters on social media. So you can find Brent there. Brent's helping out there in chats today. Thanks, Brent. But you can find Brent on X at Brent Moore CS. You can find me on X at Cameron May CS. So here's my handle. Make sure that you spell these with precision. Lots of similar handles out there. This one's mine. But I post regularly on social media, and if you reply to me on X or now also on LinkedIn, I try to reply right back to you as well. So yes, that raises the point that you can follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS will take you right to my profile, and you can follow me right along with this small but growing audience. Mike, Thanks for joining. Hey, I just noticed that Mike was here, Savannah, and everybody else. Thanks for being here. Alfie out there in Australia again. Hello, Alfie. Now, I also want to say thank you to everybody that's already clicked the like button on this video. That's definitely helpful. When you click that like button, it gives your presenter a nice pat on the back, but it also tells YouTube, hey, I like this. Let other people know about it, and we get a little promotion in the YouTube algorithm, helps more people find these discussions. A final reminder, though, is there is a survey out there in the chat window. So if you would now click that survey link, if you haven't done it already, give me some honest feedback. I always appreciate it. I will read through those comments. I read through that data. Very helpful. Thanks, Brent, for reposting that. Mike says, what about MySpace? Never did have a MySpace account. Nope. But in any case, guys, thanks for giving me your time and attention. I will look for you at a future webcast. I'll also look for you on social media, on X and LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.